Welcome to the channel, everybody. I have an exciting face here today, and I know you haven't seen him yet because he's always on the back end of Nurp, and his name is Marcin. He is part of the product development side of things and is always working on building out the best, most sophisticated code to make sure that our algorithms are always optimal and up to date. Welcome to the channel, Marcin.
Welcome. Thank you for having me.
No, it's a real pleasure, and I appreciate you taking your time out to sit here, even though I don't really have much data or anything to go over, but more so go over your data for the channel. Before we get into the exciting stuff you have, I'd love to know a little bit of your background and where you came from and how you even got into the coding space.
With pleasure. So I'm a computer scientist by training. Right after graduating, I got a position at CERN where I was a data analyst for one of the experiments. That was really exciting, a job where I was looking from data coming from LHC, which is one of the most advanced experimental facilities in the world. So that was pretty exciting. And later I got more interested in finance, and I also got a position at the pension fund of CERN, which is actually a huge fund because they manage roughly 5 billion US dollars. So that's the considerable amount of money. And that was run by a relatively small group of people, around 25 professionals, split into different asset classes. And initially, I joined as a quantitative analyst, trying to build models for the optimal portfolio allocation. And over the years, I got into the position of the head of Quant IT, where I was running a small team and also a number of quantitative strategies. Later, after leaving CERN, I joined another asset manager in Switzerland, and I was a senior portfolio manager and quantitative strategist, responsible for setting up a system for systematic trading for the firm. And I was also responsible for 5 portfolios running for clients. And that was my last position before joining Nurp, and I'm very happy to be here.
Wow, that is a pretty serious roster of history you have there. First of all, anyone watching this that doesn't understand what CERN is, I don't understand either. But what I do know is they have pretty sophisticated machinery, and I think they're working on really interesting things. I believe one of the projects I looked up was like trying to split atoms, is the whole facility underground? Is it
Well,
exposed?
the facility is quite incredible, and there are many experiments dealing with different things. So there were all sorts of ideas there. Splitting the atom was one, creating antimatter was another one, and the biggest part of CERN is really what's called LHC. So it stands for Large Hadron Collider. It's basically particle accelerator that is roughly 28 kilometers in diameter, and it's underground, and roughly 100 meters underground, under Geneva and surrounding areas. And they accelerate particles close to the speed of light and collide them. And in that point of collision, there are huge, you could think of it like photo cameras that take pictures of what's happening when these particles collide. And that's very exciting because these cameras take so many pictures, like millions of pictures per second, and store it all in crazy big databases. So there's plenty of work for computer scientists, engineers, data analysts, and yeah, all sorts of engineers, and of course physicists as well.
That is, there's no words to say how impressive that is, actually. Just goes to show you definitely are talented, and we are beyond happy that you're on the NERP team. I think anyone watching this can kind of conclude, like, if he can analyze and put data together on matter and dark matter and things that we don't even understand, I'm pretty sure you could put some code together to figure out financial markets.
Yeah, both problems are difficult to solve.
Well, that is amazing. I think that is enough of hearing how excellent your roster of history is. And I would love to now dive into some of the product side of things that you're working on. And I believe you have a presentation that you wanted to present. I'm very interested if you could go ahead and share your screen so we could see what it is on a day-to-day basis that you're looking at and what you've gathered for the audience here today.
One part of what I wanted to share with you is my recent work on the developments and changes to our one of the main algos that we run, namely it's Fed. And I was working on correlations and portfolio construction. So in the portfolio optimization framework, we are trying to solve the problem that basically many asset allocators, asset managers try to solve. And there is a fairly well-established framework to work with on that. So it's based on the modern portfolio theory introduced by Markowitz in the 50s. Later, Markowitz received the Nobel Prize for that, so that's a well-known, well-established framework. And basically, the idea behind this is like we have a portfolio which is really a combination of different investments. In our case, these are different FX pairs. And the goal is to make the portfolio as profitable as possible while keeping the risk low. So that's the goal. And here I have a little diagram which is only for like illustration. It is not based on real data, but it is a good illustration of what's happening. So we have individual assets which are shown as dots here in this space that has two dimensions. On one dimension we have risk. So on X dimension we have risk. And on the y-axis, we have the return. So as you can imagine, we would like to be as much on the left as possible because we want to keep risk as low as possible. And then we want to be as high here as possible. So we want high return with low risk. And that's the overall goal of the portfolio. And the risk is really measured by how much the returns of an investment vary from day to day, for example. This variation is also called variance. That's also why the portfolio that we would like to build would be called the minimum variance portfolio. So what we are really focusing on here is to how can we build the safest portfolio that we possibly can using the assets at hand. And by assets, I mean the trading pairs of Fed in this case. So we can do that because not all the correlations, because the assets are not perfectly correlated. So there are some that correlate very highly, and there are some others that exhibit zero or even negative correlation. So by putting together assets with low correlation, we can achieve superior returns with lower risk. So this is really the exercise that I was trying to solve here. And I can show you some charts I generated. So on the left, you see the different FX pairs. This is a chart starting from 2015. So this is basically the evolution of different FX pairs. So on the surface, it looks like there is not so much correlation because they all seem to behave almost independently. But if you look at the correlation metrics, actually it reveals that there is plenty of correlation with many green parts denoting relatively high correlation between the pairs. There's also another lens that we can use to look at this, and this will be looking at the performance of Fed trading different pairs. So what you see here is a backtest of Fed, also from 2015, of the same pairs, and that's the performance. So we can ask ourselves, okay, so what is the correlation here? And as you can see, the correlation of Fed trading these pairs is much lower than the correlation of pairs itself, as you could see here. So that's a very good sign, but still there is room for improvement because some pairs actually show some level of correlation. So there is room for improvement. So if we look at our pre-selected pairs, these are the pairs that we already pre-selected after a few rounds of screening. We could allocate them scores depending on what this Markowitz optimization would allocate to these pairs based on the correlations that we could see in pure FX pairs, or based on the correlation that we see between the Fed algorithm trading these pairs. So what would be more important for us is how Fed would be trading them than what the pairs are doing themselves. But both views have merit, so we actually use both of them to get the total score. And the higher the result, the higher the value here, the more we should allocate to these pairs, and the lower it is, the more risky the pair could be from the portfolio construction standpoint. So that's one of the views that we use to provide base case guidelines for our users. And the other very straightforward measure could be looking at the maximum historical drawdown of any given pair through the 9 years of backtest. As you can see, there are two pairs that had a slightly higher drawdowns historically. And in the end, we decided to combine these two views, so the correlation and the risk view perceived as the maximum drawdown, to come up with final allocation. And as you can see in the final column here on the right, so those pairs that receive the score of 1 would be considered the base pairs, and those that have allocation of 0.5 would be considered higher risk pairs. So basically, in the end, what we show to users is it might be just a table like this, but there is plenty of analysis, optimization, and a lot of work that goes into that behind. Another thing that I could show you is the comparison of the new and old settings that we also generated. So we've been trying to minimize the risk, so that was really the goal. And with selecting only 11 pairs out of the 23 pairs that we've been trading before, and increasing the lot size just slightly, we could reduce the risk significantly. As you can see, the maximum drawdown for the strategy has been reduced from 73 to only 37%. And also the number of drawdowns exceeding 10% over the last 9 years was reduced from 16 to 6. So that's a very, very good result. And the volatility of the strategy was roughly cut in half. So as you can see from this analysis, we managed to cut the risk of Fed in half. And of course, the question you might ask, how does the return look like? Because they often come together. So as you can expect, the return is a little bit lower, but actually the reduction of return is very, very small compared to how much we managed to reduce the risk. So the average yearly return was reduced from 29.8% to 25.2%. So that's actually only 4.6 percentage points reduction for half of the risk that we are taking now. So I'm very happy with these results, and I think this will be this will also be something that our community will appreciate.
Yeah, I think that's a very fair trade-off. So essentially, we cut the risk basically in half. We only diminished the return by 4.6%. Meanwhile, cutting more than 30, 50% off of the risk.
Correct. Yes, that's a very good trade-off.
Thank you for sharing all of that data with us. I found that very insightful. So basically, what you just presented was more so of historical data, but also an evolution happening from an old model to a newer model. And how soon is that being incorporated?
Well, this is something that the whole team is working on, and it will be released in the coming days. So we want to provide the results as quickly as possible, but also be sure that what we present is thoroughly tested and very robust. So that's always the priority.
Nice. When it comes to testing, what is the typical standard amount of time where you deem a test finished and worthy or not worthy?
Yeah, that's a good question. And actually, so there is the whole development process. So it could be seen from many different perspectives, but I would say the main one could be seen as the main part where we develop the algorithm and we really test different ideas. We test it on different data sets and so on. But then the question is, how does this algorithm perform on different data set or on the data it never saw? So here we are really touching on two subjects. One would be the Monte Carlo testing, and like what can we expect from our algorithm going forward, and also how can we make sure that we are not overfitting the strategy.
Okay, so let's assume that myself and everyone watching this doesn't understand the two terms that you just said. So one of the terms was a Monte Carlo and the other one was overfitting. Can you just give me a quick layman term overview of what those can be?
Sure. I can share a few slides if that would be useful and walk over with an example. So Monte Carlo testing was was actually a method developed by Stanisław Ulam. That was a person working on the Manhattan Project. And the name Monte Carlo comes from influence of his uncle, who was a gambler, and they went together to Monaco. And Stanisław, as a mathematician and I would say early computer scientist, was really inspired by the world of gambling and was trying to see how randomness can impact different processes. So he came up with this method that actually now is widely used and is a fantastic method to test different outcomes. And one way we employ that at Nurp is the following. So when we do the back test, we have, let's say, 10 years of data for the algorithm. The returns of day by day, we have a lot of analysis that we can do. So we can put all the trades that we've made, that the algorithm made, to a big basket. And now we could ask ourselves, okay, maybe with this data we could simulate not only the actual years that we had in the past, but some hypothetical random years that we could see going forward. And this is really where Monte Carlo method comes in and helps us do this analysis. So what we do, we can draw from this big basket of the trades. We can draw some randomly pick trades from it and create little buckets. And in this case, we are creating 10,000 little buckets. So we are creating a lot of buckets, and each of these buckets will simulate 1 year of trading. So we are saying, okay, how a year of trading ahead could look like just based on what we experienced in the past. And this will be very useful because we could see all sorts of outcomes, and we could see that maybe what we just saw historically is a small sample of what could possibly happen. So to give you an idea, so if we simulate this and put it on the chart, it will look something like that. So we'll be starting at zero, and then we will be simulating. So each line here simulates 1 year of trading. In this case, the algorithm was making 433 trades per year on average. So we will be always having 433 trades in this path. But as you can see, some paths were very lucky because they were only having the fantastic positive trades, whereas some paths here would be very unlucky. And the question is, how would the distribution look like? So what is really something that we can expect going forward just based on the randomness? So this is quite useful, and the data I'm showing you are not related to any particular algorithm that we have in Nurp. It's something that it's another algorithm that I was working on, but the results are not yet strong enough to be released. But as you can see, this algorithm averaged roughly 30%, but you could see that the distribution is very wide. So you could have a year where you are making 0, or you could have a year where you're making like over 80 or even over 100%. So it's really statistics. And this is where Monte Carlo really helps us to analyze this possible outcomes. So obviously we would like to have algorithm which has a very high expectancy, and also the standard deviations of outcomes is relatively narrow around this positive expected value. One last thing I wanted to show you is like some sort of analysis you can run based on this data. So we could see that the mean return in this case was 32%, but in the 5% of worst outcomes, it would be less than -3%. So we could actually even lose money on that algorithm, and in the 5% of best cases, it would be close to 80%. So you can see that in this case, the dispersion is very wide, and Monte Carlo testing helps us to spot things like that, identify potential issues, and make more robust algorithms going forward.
Wow, very interesting. The other term you said, overfitting. What does that mean?
Well, overfitting is a very big problem for anyone trying to build algorithmic trading system, because really what we have is the historical data. So everybody tries to build something that works in the past, works on historical data, but we have relatively short history. So if you compare it, for example, to like algorithms that do image recognition, they are trained on millions of samples. And here in trading, we only have limited amount of history. Like we have maybe 10 years, 20 years of data. That's really not a lot as compared to like all the machine learning tools, all the models that in other domains are trained on millions of data points. So overfitting is quite difficult, and we could see it as we could see it as something that we want to avoid. So basically, overfitting would be fitting too much to the historical data and creating algorithm that works very well on historical data but doesn't work in the future because it was overfitted. So that would really be a simple definition.
So essentially, it's just trying to over optimize the algorithm, which actually hinders it because of just overdoing it.
Exactly. Overdoing it would be bad. So there is some sort of a sweet spot where you optimize your algorithm, but you shouldn't do it too much because otherwise it will be too fitted to the past and not sufficiently flexible to handle real new data coming in.
Well, thank you for all that data, Marcin. I found tons of value in it, and I know if I found value, a large portion of the audience will find tons of value from it too. I've had tons of people say, "Who are the people working on it?" Well, here's one, and I'm going to make sure to bring everyone else in the product side to the forefront and be able to articulate themselves to let everyone know what they're working on. And speaking of working on, I'd love to know, this will be the last question before I let you go. What is it that you do the moment you wake up for Nurp on a day-to-day basis? What is the top priority when you step in to crack your knuckles and get to work?
Yeah, great question. There's plenty of work here to do, and I would say I split my time into few main domains. So one would be maintaining and improving existing algorithms, and that's a big part of the job to check if they perform according to the expectations, if they are not overfitted, if they still perform as they should. So that's a big part of it. Then there is I would say we are still thinking of new ideas of how to improve existing algorithms, how to make them better, how to make them more robust, how to help them handle unexpected events, and that's also a big part of it because, as you know, like financial markets are not physics. Like if we drop something, we know if we let something fall, we know that it's going to fall. But in financial markets, occasionally it might go sideways, and it's really something that we also should consider. So there are many things that come into that. The other part of what I really enjoy doing is developing new algorithms, and that's especially exciting because we want to offer to clients the wide selection of best possible algos, and developing new ones, staying ahead of competition, building most robust trading systems is really what makes me happy and what I really enjoy doing.
Awesome. Well, I've had you for 26 minutes now, and I appreciate every single second. This has been a blast, and I really look forward to not only meeting with you again, but more people in your department to help people understand of how hard we are actually working on our algorithms, and more importantly, that we really have a very robust quant department that is diligently working on developing the best products on the planet. So again, thank you for your time, Marcin, and everyone for watching this. If you got any value, please leave a like, comment, answer, subscribe. And like always, everyone,